Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is May 29th. Today we're going to take a look at Enterprise Product Partners. This is a limited partnership out of the energy sector. Let's jump in. And before we get into the video, if you could do me a favor and hit that thumbs up button down below, make sure you subscribe, hit that subscribe button, join us on this journey to financial freedom. Hit the notification bell so you're notified whenever we put out any new content. Drop a comment down below. Let me know what you think of the videos. Let me know what you think of Enterprise Product Partners. Love to hear from you. And share with anyone who you might think that might find value in the videos. Any investors out there, dividend growth investing is what we focus on this channel. Doing all that really does help a small YouTube channel like mine with the YouTube algorithms. So really appreciate it, and really appreciate all the subscribers out there. Very, very excited about the growth of the channel, and thank you so much for continuing to make it worth doing these videos. Seeing the continued increase in the subscribers really does make me feel like I'm doing something that is of value to those of you out there who watch the video. So thank you all out there who have done that. Now, this is the vested interest stock screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I am interested in investing. Just because it meets 5 of 8 or 6 of 9 does not necessarily mean I'm investing. It just means it goes on my watch list, and then I do more of a deep dive into the company. It's also a back check on the companies in my portfolio, which, full disclosure, Enterprise Product Partners is one of those videos, or is one of those stocks in my portfolio that we're going to cover in this video today. And so this will be a little back check on that company for myself. Now back to Enterprise Product Partners. Go ahead and check them out at www.enterpriseproducts.com. That is their homepage where I pulled this information from. Again, that's www.enterpriseproducts.com. www.enterpriseproducts.com. That is their homepage. Now, as you can see here, this is a map of all their locations. Enterprise Product Partners LP, again, a limited partnership. So let's talk about that for a second. This particular company, it comes with some tax implications. It's treated as ordinary income. You will get a K-1 at the end of the year that you have to file with your taxes, and the dividend payouts will be treated as income on that K-1. So make sure that you understand there are some tax implications around this company. You are going to have to pay taxes on this as if it was regular income. So whatever your tax bracket is, that's what you'll be charged taxes towards this. That's one of the downsides of it being a limited partnership. It's a publicly traded partnership listed on the New York Stock Exchange, ticker EPD. Our origins began with Enterprise Products Company, formed in 1968 by Dan Duncan and 2 partners as a wholesale marketer of natural gas liquids. Today, our integrated energy infrastructure network provides midstream energy services to producers and consumers of natural gas liquids, crude oil, refined products, and petrochemicals. We link producers from some of the largest North American supply basins with domestic consumers and international markets. And that's what they really focus on. They are the pipes that natural gas and oil are flowing through, and they charge the companies that are pumping their oil and natural gas through there a fee to use those pipelines. So they are not a driller of natural gas or oil. They are the pipelines that provide the natural gas to for the drillers to wherever they are refining or wherever they are selling the products from. And again, you can see here a United States map and all of their different locations: propane terminals, refined products terminals, crude oil terminals, import-export terminals, natural gas processing plants, natural gas marketing hub, natural gas storage, NGL storage, NGL fractionation facility, octane enhancement facility, propylene fractionation facility? I think it's fractionation facility, propylene dehydrogenation facility. So this is all of their facilities and pipelines that they own. And we are talking about Enterprise Product Partners, again, a limited partnership company, ticker EPD, out of the energy sector. Closed out the day at $28.05. They were down slightly. That's why we're looking at it, 0.14%. So not a big drop, but a drop nonetheless. 52-week range as low as $25.21, as high as $29.99. And I know it doesn't seem like it, but it is closer to its 52-week high, but it is still also within 15% of its 52-week low. Not a big spread here from the low to the high, though, so I don't know that that's as important as it would be on some other stocks that may run up significantly. So right now it is closer to its 52-week high, but still within 15% of its 52-week low. Market cap of $60.912 billion. Beta of 0.99, so just slightly less volatile than the overall market. PE ratio, price to earnings ratio, $11 per share, very low. Anything under 15 is low. Earnings per share, EPS sitting at $2.55 per share. Earnings date coming up sometime between June 30th or July 30th and August 5th. Forward dividend is $2.06. That is on the year. It is a quarterly payer, so divide by 4, though we will see that here in a minute. Very high starting dividend yield, 7.33%. Ex-dividend date, April 29th, so we are past that. They did pay out on May 14th. So if you were to buy them now, you would be in line for the next dividend, but you would have to wait a couple months to get it. 1-year target estimate, $33.18. So Yahoo Finance, where I pulled this information from, does see some upside as far as the price per share. We're going to jump over and look at dividend yield theory to see if this one is potentially undervalued. 5-year dividend yield average is 7.82%, currently 7.33%. So according to dividend yield theory, this one is potentially currently overvalued. Payout ratio is above 75%. I like 75% or lower at 78.63. So a little on the high side, but I will say for this type of company, limited partnerships, REITs, BDCs, business development companies, they typically do pay out, and in the case of REITs, they are required by law to pay out more than 90% of their free cash flow in dividends. So I am not as concerned with limited partnership. They are going to pay out a higher than normal payout ratio of their free cash flow because they are returning capital back to the shareholders. It's just what they do. So this doesn't concern me. If this was like let's say a Chevron or an ExxonMobil, then I would be concerned. But for this particular type of company, I am not. Now we're going to jump down to free cash flow, and we want growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends to go along with it. Going back to 2020, you can see here $2.6 billion in free cash flow. Big jump up in 2021, $6.2 billion. Bit of a drop in 2022 down to $6 billion, and a bigger drop in 2023, $4.3 billion. It is up from 2020, though it is a bit up and down. We're going to say, I guess it's technically not growing free cash flow, though it is growing from 4 years ago. So you could put a check here if you wanted. I'm going to leave the check off. I think that I left the check off on this one. So it could go either way. You're up over the last 4 years, but it hasn't been consistently growing. You have two outliers here in 2021 and 2022. Above normal growth really is what I'm seeing there compared to 2020 and 2023. So it has grown since 2020, but not consistently over the last 4 years. They are repurchasing their own shares, which I like that. A company like this, limited partnership, sometimes they tend to dilute their shareholders and issue more shares. This company is not doing that, so I like that they're pulling shares out of the market. Well, we're going to jump over to stockanalysis.com, and I recommend more than one site so you can make sure the information you're getting is accurate and up to date. Pick any sites that you like. It doesn't have to be these two. These are just two that I like. I'm not affiliated with either site. So, you could use Google if you want, or any other. Seeking Alpha, I think, is another one a lot of people like. Any sites that you like, just make sure you're not blindly following just one site. Because, again, sometimes the information is out of date or it could be inaccurate. Now, they have 12 stock analysts that have taken a look at this. They call it a strong buy. They have a low estimate of $28. It's currently just above that. So if it dropped down to their low, that would be a 0.2% decrease from where it currently sits. Average estimate of $32.83, which is pretty close to what we saw with Yahoo Finance on the previous page. That would be a 17.02% increase from where it currently sits. And if it happened to hit their high of $36 per share, that would be a 28.32% increase. All the while, you could collect that 7+% dividend yield. Now we're going to jump into statistics here. We're going to look at return on equity and return on invested capital. This tells us how efficiently a company is reinvesting its capital back into itself, making acquisitions, paying down debt, buying back shares, paying dividends, doing the things that they do with capital, building out more pipelines, fixing the pipelines, that sort of thing. Return on equity, I like 10% or better. They're sitting at 20.4%. Very nice. Return on invested capital, again, I like 10% or better. They're sitting at 11.37%. Very good numbers overall. EPS growth, I like 5% or better. They're currently not there, 2.33%, so no check for them there. Revenue growth forecast at 3.02%. Overall, very good numbers. Let's jump over and look at their dividend history. Again, before we do that, we're going to look at my position. I am long EPD. I do have 248.253 shares. My cost basis is $25 per share, right? I am up 11.96%. So again, this one is one where I don't mind adding to it, even though it's above my cost basis, because my cost basis is so low, right? And I'm not looking to add a lot, but I don't mind, 2, 4, 6 shares, especially if it pulls back, back towards the $25 here. If it was to get under 27, I would probably add significant to it. But right now, I don't mind adding a couple shares here and there whenever this one pulls back on a day. And to be totally honest, I added a couple shares today to this one, even though, like I said, dividend yield theory says this one is potentially overvalued. My cost basis being so low, it's not going to raise it up enough where it's of concern to me. Now, a quarterly payout ratio, they say 81%. We saw 78. Either way, it's higher than what I like at 75%, but because it's a limited partnership, they typically pay out a higher payout ratio of their free cash flow. It's just the nature of this type of company. Dividend growth, 5.18%. So not only are you getting a 7+% dividend yield, you are getting nice dividend growth here, 5.18%. 10 years of growth, buyback yield is positive at 0.12%, shareholder yield at 7.49%, all good numbers. Now we're going to take a look at the dividend payout here going back to 2021. You can see they were at 45 cents. January 2022, they raised it up to 46 cents and some fractions of a penny. July 2022, up to 47 cents and some fractions of a penny. January 30th, 2023, up to 49 cents and some fractions of a penny. July 28th, up to 50 cents. January 2024, up to 51 cents, and that's where it's been maintained. But you can see here, right, 2022, they raised it up once and twice. 2023, they raised it up twice. So it's not just one raise per year typically. Typically, they're doing at least one, if not two. So that is very good to see. They are returning a lot of capital back to you as a shareholder, back to me as a shareholder, which I really, really like. And I like that they are not a driller of oil, but they are just a pass-through company where they're basically charging a toll, right? The companies that drill the oil and gas, they use their pipelines to ship it, and they are charged a fee to ship it. That is the nature of this company, and that is what I like about them. Now let's take a look at the vested interest stock screener to see if it still meets the 5 of 8 that I'm looking for on this one, because it is not a bank, so I'm not looking at price to book on this one. Understand the business. That's where we started. Growing free cash flow. You could put a check. It is growing over the last 4 years from where it was 4 years ago, though it is not consistent growth. I did not put one there. So, I mean, you could have go either way with that one, really. Growing dividend, a check there. Dividend payout ratio 75%. No check there, but I'm not concerned with that because it's like REITs, BDCs, limited partnerships do pay out typically higher than normal free cash flow. Dividend yield theory said it was potentially overvalued. Buy below a current cost basis or within 15% of its 52-week low. $28.99, I believe, is where it would sit at 15% of its 52-week low. So it is right there, even though it is closer to its 52-week high than its 52-week low. Return on invested capital and return on equity are both over 10%, so a check there. The earnings per share growth was not at 5%. It was at 2.3, so no check there. 4 checks. You could, like I said, argue that they do have growing free cash flow over the last 4 years, but I didn't put it there. It is one in my portfolio. I am not concerned with it because of the, again, 75% or less. It's never really going to meet that metric, so there's one that it would never really meet. And the growing free cash flow is growing. It just hasn't been consistently growing. So this one is going to stay in my portfolio. It is not one I'm concerned with, even though it doesn't meet 5 of the 8. But if you are looking for something in the energy sector with a very high starting dividend yield with some nice dividend growth to go along with it, this is a very interesting company to look at, though because it's a limited partnership, it does have some tax implications and is treated as regular income. Well, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button down below. Join us on this journey of financial freedom. Join the vested interest community. Hopefully, you have started your own investing journey. And if you have not started your investing journey, let me know why not in the comments section below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping in. Thanks for watching the videos. Again, special thank you to the subscribers out there. You guys are awesome. Really do appreciate you all. And we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and money to never invest any amount that comes losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.